In this video, we're going to talk about how to convert term insurance to whole life insurance. And for this example, we're looking at a male, age 37. He got a preferred rating and he's purchasing $1 million of coverage for 20 years. And so that means his premium is going to stay the same for 20 years. And in this case, it's just $59.25 a month that he'll be paying. Term insurance is very inexpensive. Now, the great thing about term insurance, it is inexpensive, but convertible term is convertible without showing evidence of insurability. So this gentleman can convert to whole life insurance anytime through the 19th year of the policy. And even if he is not doing as well in his health, maybe his health has declined, or maybe he's not even insurable, he can still get the whole life policy at the preferred rating he received when this policy was first underwritten and issued. So let's look at what that would look like. Now, I also have to give a little disclaimer here. Anything I show you is just an example of what could happen right now. So in 3 years, say this man comes to me and he's age 40. I'm going to show you an example right now of what it would look like for a 40-year-old to get a whole life insurance policy. But this individual, 3 years are going to pass before he's age 40. And so what I show today, I cannot guarantee that he will receive in those 3 years, because insurance companies are always using the best information that they have. And so their products change, and sometimes the actuarial accountings have to change to reflect what's happening in the population. So I cannot guarantee any of these illustrations that I show today will be available 3 years later. And so just keep that in mind. Once you actually sign a whole life illustration and pay for it, then you have a contract. That illustration becomes a guaranteed contract, and that those numbers cannot go any lower. They can do better, and that's the non-guaranteed side. But I just want to make that a little disclaimer there so that you understand what I show you today is not exactly what he will get 3 years from now. Okay, so he's age 40 and he's coming to me with $10,000 and he wants to use that for his premium amount. Now I'm going to do this on an annual basis, and of course he doesn't have to use the whole $10,000. He could have said $5,000, he could have said $20,000, but for this case he did $10,000. So I'm going to show you some illustrations. The first one I'm going to show you, I do not recommend. But the reason I'm showing it to you is because we're going to learn some things that will translate to the illustration that I do like, and you'll quickly understand what is happening. All right, so here we go. We're going to look at this illustration. Notice up here in the right hand corner, his age has changed. He's now age 40, but the rating is the same. Also, here is the initial death benefit, and we see over here, down here, his premium is $10,000. And here again is his initial death benefit, and his cash value is at 0. That's what I don't like about this policy. And the cash value for the second year is 0. Cash value in the third year is $9,586, but after paying 3 premiums of $10,000, I paid $30,000. I don't think that's super exciting to see the cash value there. So we'll talk about that. See, here at Life Benefits, we know that you have a greater need for cash value than you do for death benefit during your lifetime. So if you need a higher death benefit than what your whole life is giving you, hey, we'll supplement with some term insurance. Hey, term insurance that is convertible, because it's a great thing. It'll cost you less, and you'll have more flexibility, more for your money. All right, that's important to me. Now, the reason I wanted to look at this illustration is because underwriters always underwrite by the 10th year value. Okay, so let's look at this 10th year value. Here it is. Oh, wasn't it the same amount of death benefit here in this first year, in this initial? Well, yes, it was. And so now we see that the reason I have shown you this illustration, so that we're going to build on your understanding. Also, just quickly note that you have 0 paid up insurance here. We're going to be talking about that on the next screen. So let's go to that next screen now. Okay, this is an illustration I like to see better. Back up at the top right, we do see he's age 40. He's preferred. Look at the initial death benefit, quite a bit lower than what we saw earlier, right? Okay, let's go down. We still have the premium of $10,000. But look what we like. Cash value in this first year, $6,779. And that's good. I paid $10,000. I'm going to get more than half of that in cash value. That's especially good. Of course, he can do that at his age 40, and also with a preferred rating, that's going to look very good. Notice also here, maximum paid up insurance. We're going to talk about that in just a minute. Also, look at the death benefit. Do you see that doesn't match what we have up here in the right-hand corner? A lot of people don't know why this is, and if you don't, you're going to know in just a minute, and that means you'll know a lot more than a lot of agents out there even know. Okay, so here is the reason. That $10,000 had base premium, and it also had paid up additions. I can't spell today. Paid up additions, PUA. It's got a PUA rider. What does that PUA rider do? Well, it's an insurance product, so it has to buy a little bit of insurance. So it is buying the difference here that you see, and that's becoming paid up insurance. And because you have paid up insurance, it's like equity. So like if you have a home and you put, you're buying a home and you put $100,000 down on it, that's $100,000 of equity that you have in the house. You own $100,000 of it. And because of that equity, you can have cash value available to you. Also, because of this equity, you also get to earn a dividend on the non-guaranteed side, but we're not talking much about the non-guaranteed side, but I just did want to point that out. That's a little extra there. Okay, so the paid up additions rider buys this a little bit of death benefit. It also buys you the maximum paid up the paid up insurance that allows you to have the cash value. Very nice. All right, so remember, what are the underwriters looking at? They're looking at the 10th year value. Okay, so here it changed. Notice we paid this premium of $10,000 for 3 years. We've got the base of the $2,884 and the difference in paid up additions. Now, people often ask me, couldn't we pay that $10,000 longer? Oh yes, absolutely you can if we illustrate it that way. So we could have left the $10,000 on for 4, 5, 6, we could have left it on for 10 years, we could have left it on for all years. But for the purpose of this demonstration today, I wanted to get that cash value in the first year as high as I could. Of course, when we are converting your term insurance, we'll have this discussion and we'll iron things out so that you're pleased with what you're purchasing. So now, what does this 10th year mean to the underwriters? Let's go look at that. So you had, this person, this male, 37, now 40, had $1 million of term insurance, but we are converting out the 10th year value. So we're going to subtract that number, 305,930, and we are going to be left with $694,070. This is the amount of term insurance that will be left after this conversion. Now, you can keep this amount of term insurance. Your premiums will automatically go down because you no longer own the million, you own this lesser amount. So your premiums will decrease accordingly. So if we look at the total death benefit in that first year, we see it's $254,882. And so the total initial death benefit you're going to have at this point, including the whole life and the remaining term, is the $948,952. Now, notice that that is less than what you had before you started. But you do have cash value now. You have a permanent policy that you're purchasing. And let's look. The first year, yes, you're down by about $50,000. The second year, we're closing the gap. The third year, we're right back to where you wanted to be as far as the amount of coverage goes. Now, good news for you, this term policy that you still have left, you can continue to convert that in another 2, 3, 4 years. You can continue to convert that, remember, until that year 19. So that's kind of nice to know. So you could have multiple whole life policies out of this particular term policy. Now I want to look at another example. This time I want to say that this male age 40 came to me, and instead of giving me a dollar amount that he wanted to spend, he said, I want to convert 500,000 of my term. So let's take a peek at what that would look like. All right, here we are, 500,000 of term. Now I looked at this one way. There's another way to look at it. So what I did is I first looked at the 10th year value of death benefit. And so I got it, hey, within $2, not too bad. And then we can look at the premium and all that. Now, the other way I could have done this is in the first year, I could have made this right about 500,000. If that was the case, just realize that this 10th year value down here would have been higher. So when we subtract out how much we've converted, he'll be left with less term insurance, but he'll start with that 500,000 right here. Fair enough? Okay, now let's see if we can translate what we learned in the last video to this video. Okay, we see that the premium is higher, and that's because we've got a higher amount of death benefit. We also see that we have base premium here. We drop that PUA rider. So that means that this amount here, reflecting that paid up additions rider, should be more than our initial amount up here, which it certainly is. Very good. So we do have paid up insurance, which allows us cash value in that first year. Very good. I'm liking the looks of this policy. Now let's go through what happened with the term conversion. We had $1 million of term, and he converted 10th year value, 500,000. Remember, if it was 500,000 in that first year, this number would be higher, but it's not for this example. So he's left with the remaining $499,998 of term insurance. Of course, we know that the premium on that term will go down and that he can convert more of this later in the future when he wants to, still at the preferred rating. That's cool. But his total of coverage now with the 414 in that first year of the whole life, now his total coverage in that first year is $914,172. Now we see that narrowing here the second year, and by the third year we're back up to that whole $1 million that he wanted to have. Okay, that's cool. So now let's look at one more thing. Let's say he doesn't come to me at age 40. Instead, he comes to me at age 47. And he also wants to convert the 500,000. I'm going to do it like I did, 500,000. I'm going to do it like I did this one, looking at that 500,000 in the 10th year. Let's go take a peek at that. All right. Oops, let me get this going again. Okay, there we are. Now we have him at age 47. And you'll see that the death benefit here is very similar here, a little bit off, but I was trying to stick with these round numbers for the premium. Notice the premium increased by quite a bit. Why? Just because of his age. That was the difference here. So the age is going to make a difference in how much you pay in your premium. Again, we're getting really close to it, but I just wanted you to see what the differences are. Yes, the longer you wait, the more your insurance costs you. But of course, with that term, the convertible term, you are guaranteed the preferred rating. So if your health declines, you don't have to have that concern as far as how much you're going to pay for your insurance. that way. So I hope this video has been helpful to you. When you have questions about converting your term insurance and how to do that, of course, we'll help you with that at the time. We'll prepare an up-to-date illustration for you so you can see how the numbers work out. Thank you.